What's going on, guys? Brian's here. Welcome to the YouTube channel. When you first start out trading, chances are you learn about technical analysis. Right after technical analysis, you learn to compound the information and learn technical patterns such as bull flags, double tops, triple bottoms, all those fancy names that you'll generally come across. However, after you trade for a while, you'll start to feel as if those patterns don't work. So I wanted to do a video discussing the truth behind technical patterns, as I don't believe they are intended to actually predict or anticipate some sort of directional bias. I believe that is a secondary function to technical patterns. The primary function is risk management. So let me explain. If we take a look at this right here, this is the general. Pretty sure you've come across something like this again early in your trading career. You first learn about support and resistance, which is probably the building blocks for understanding technical analysis. From there, you'll then learn about putting that together and forming trend lines. So you'll have a resistance and a support, but it's just on an angle versus horizontally like this right here. And you will learn about previous resistance becomes future support. As we move right along, again, we'll have trend lines. And then from there, you'll learn about understanding different candlesticks. And the ones that, in my opinion, are the most important ones are to understand the neutral or the indecisive candlesticks, referred to as dojis. It's not necessarily the candle that's important. It's more or less where it forms that's important, but I'll get into that in another video. Then we have retracements. A 50% retracement is pretty important, but we'll get into that again in another video, just brushing over some of the basic general things that you'll learn. And then from here, we get what's referred to as technical patterns, and some of the most elementary or basic ones in which you'll learn about are triangles. So we have symmetrical triangles, ascending triangles, and descending triangles. Now, these patterns right here, when you're a beginner, can become a little bit dangerous because you see the term bull flag and you immediately think it means price has to go up. But again, the intention of this video is to understand, guys, that these patterns are not set in stone, and just because you see a bull flag does not mean price has to go up. The importance behind learning about these patterns is to understand risk management. When you see a bull flag that forms, it's telling you that this is potentially a good place to get long, and if the price was to reverse on you, where to take your stop loss. So in other words, if you see a flag forming like this, here's what's referred to as the pole. Then you have price consolidating during this pattern here, and this is what's creating what's referred to as the flag. It is a bull flag because of the direction in which price is heading. So price has been going up, and then it creates this flag here. It is letting you know if you take this entry long on the breakout, your stop loss can be below this trend right here in the flag. Or if you decide to get long at the base of the flag, your stop loss can be here. And generally, it's taught that you want to use the distance of the pole as an idea for how far price can go as a potential profit target. Again, this pattern forming is just letting you know there is a potential opportunity coming up. However, the most important thing with trading is risk management. So if we have this pattern forming and you decide to take it long at the bottom of this trend line, because that's what it is here. This is a flag, but right here we have a trend line. So this is just like when you first start trading, you learn about support and resistance, and then you learn about trend lines. This is just a channel. So a bull flag is just a pole and then a channel, or price heading up, and then it forms a channel. And when it comes to identifying that, that means you have some sort of a structure on your chart, or you have some sort of order out of the chaos that is price action. So if we have this here and you take this long and you decide to set your stop loss down here, if you were to say this is going to be about $1, so this is your risk, and you're targeting about 3 times that much, this would be an estimate right here. That is a risk reward of 3 to 1, roughly speaking. So this is you risking $1. So I'll put that in red for here. This is risking $1 with the opportunity to make $3. This is a good risk reward setup. It is not necessarily about the pattern. It is about understanding this first. And this is the truth about technical patterns, in my opinion. It is about creating structure and is about bringing some sort of order to the chaos that is price action. The primary function is to develop a risk management plan for yourself versus just throwing darts at the wall and hoping something works out. The bull flag is helping you identify a plan for yourself. Your plan is you're going to try to make $3 and you're risking $1. And this is where you set your stop loss. This is where you're taking profit. profit, it is creating a structure, because without the pattern in itself, you don't really know what you're trading. On top of that, the technical patterns allow you to journal better, because when you put in your notes, why did you take this trade? It's very easy to say that you took the trade because you saw a bull flag. The bull flag is the name to a visual pattern that a lot of other traders see, but the bull flag does not mean price has to go up. More importantly, context is very important. Bull flags do not work that well during a bear market because the market is going down. That is the trend for that market. If we are in a bull market, then bull flags work better. And then the opposite would be true. If we are in a bull market, then bear flags do not work that well. As we move right along, we have other patterns that are referred to as reversal patterns, like double bottoms and inverse head and shoulders and fallen wedges. Again, these names are not that important. It's about understanding what's going on with the price action, but more importantly, understanding that it's creating a structure for you to trade. And then it is allowing you to have some sort of a plan for what your risk is. So if we have a double top, for example, this is price going up. And then let's just say it hits some sort of a resistance on your chart and it gets rejected. So it comes back down and then it decides to return back to that level again. And then it gets rejected and price decides to go back down. As it is going down, this is letting you know we have a proven level here that is offering some sort of resistance. So if you were to take a short entry right here at this exact moment in time, it is telling you set your stop loss above this level here, and then you're looking to target at least 2 times the amount you're risking, 3 times the amount you're risking. Everybody's trading plan is different, but you want to at least be looking for 2 times what you're risking. So in this case here, if this is what you're risking, then you want to be making at least 2 times that much, or possibly 3 times that much. Sometimes there are great opportunities where the risk reward is huge, but again, over longevity of trading, if you can stick to a 1 to 3 risk reward type of model, you put yourself in a good position to be profitable over the long term. The pattern again would be referred to in this case as a double top, because this is the first top right here. So this is 1 and then this is 2. So it is a double top. 1, 2, this is your entry, this is your stop. It is not saying price has to go down because there is a double top. That is secondary. What it is telling you is there is an opportunity here to potentially get short, and now you know for sure what your risk is, because the only thing you can actually control is exactly how much your risk is going to be. If you are day trading and you see price break this level, you have the opportunity to see what's going to happen up here. Either you take a hard stop and you close the trade as soon as this level is breached, or you wait to see if it will come right back down and then continue in the direction in which you were thinking about. That is the way I generally like to trade, as I do not take the stop on the first breach of the level. I pay attention to longer time frames. If you're trading on something like a 1-minute time frame, a 15-second time frame, anything less than 5 minutes, you'll have to make decisions quicker. Patterns tend to work better on larger time frames, which is something to also take note of, but understand these patterns work across the board. Another very common technical pattern that traders will often hear about when they first start out is a head and shoulders. So it looks like this, price goes like this, and then it goes like this, and then it comes back down. This is referred to as the head, and then we have the left shoulder and we have the right shoulder. This is a head and shoulders pattern, but again, it is referred to as a reversal pattern, but it does not mean price has to reverse. We need to understand what is happening here and why it is a good opportunity to take a trade. If you were to take the short trade here, you are telling yourself you have a stop loss above this shoulder or above the head right here, and then you know where to set your potential profit target if price was to go back down to where it came from. Please understand, just because you see a head and shoulders forming at resistance, it does not mean price has to go down. If you take this trade short and price goes right back up and you take a stop loss, you'll then tell yourself, hey, head and shoulders do not work. But in actuality, it did work. It allowed you to take a stop loss. That is the primary function. You are taking a small risk. So technical patterns do work if you are honoring the risk management that they are intended to be used for. They are not intended to be used to tell you exactly where price is going. There is no actual way to do that, as no one can predict exactly what's going to happen with price action. We can use different tools, we can use different analysis to try to give us some sort of an edge. We can increase our probability of success as best as we can, but at the end of the day, there is no way to know with 100% certainty exactly what is going to happen in the future. What we do know is that we see a head and shoulders pattern form. We know that we are identifying a potential really good entry to open up a trade, and what we also do know is where to take our stop loss. So we know where our entry is, we know where our stop loss is, and we have an idea for where our profit target is, but we do not know if price will go to our profit target. Therefore, we have to have an idea for where we are going to take our loss if the trade does not work out. If you can cement this in your understanding of technical patterns, I promise you it will help you become a better trader. Understanding first and foremost that the pattern is there to help you identify an entry, a stop loss, and a potential profit target. That is the truth about technical patterns. I also want to take a couple minutes to think about exactly what's happening, as it's not just about the technical pattern, it's almost a little bit about common sense. Imagine if you're in the gym and you see someone lifting weights and they have this bar above their head, and this is the weights right here. And assume they have 50 pounds on each side of the bar. And as they push, let's just say they're able to do 10 reps, so they can lift it up and down 10 times. Then they decide to increase the weight and they have 75 pounds on each side, and they're able to do the 10 reps really well. Then it gets to the point where they have 100 pounds in each side and they're able to do the reps really well. However, you can see that they're starting to struggle at this point, because we know there will inevitably be a point in which they cannot keep holding or increasing the weight. If that point happens to be at 100, you take note of that. That is almost like reading price action. As price is going up, you take note that it looks like it is not going up as strong. We can see that in the candles. If the candles are really big, you see a really big green candle. It looks like this. And then you see a really big green candle. And then you see the candle get smaller and smaller and smaller, but it's still going up. That is another way of interpreting that it is essentially slowing down. It's losing its energy, it's losing its momentum. So if we take a look at this here, this is somebody in the gym and you're just sitting on the sidelines and you're observing, and then that next push, you see that they try to increase the weight again and they go to 125, but they're no longer able to make the full clean 10 reps. So you can see that the momentum has slowed. The implication would be maybe the next rep, you don't know what's going to happen. But if you wait and see, and you see that they decrease the weight back down to 100, now you have an idea of, hey, this is probably the level that they can no longer exceed for this point in time. So you tell yourself that 125. Now, if we were to just look at this set of numbers, so from 50 to 75 to 100 to 125 to 100, and you made the observation that they're struggling, you can see the muscles getting fatigued, you can see the weakness. Your guess now as to what will happen next. Will they go back up to 125? So if we were to just jot this on the side here, if we were to try to make some sort of educated guess as the next time they attempt to lift this weights, they're going to change the weights from 100. The guess will be, are they going to go from 100 back up to 125, possibly 150, or will they decrease the weights back down to 75? Again, if that is not clear, this is the current weights in which we left off at. It is 100. They will be changing the weights on their next rep. And just based on this pattern right here, if we try to guess, where will they go? Will they go back up to 125 when we already saw them struggling? Will they increase on this? Will they increase the weight that we saw them increasing it by? Because every time it went up by 25, so 25, 25, 25. So if it went from 125 up to 150, that is very unlikely, as we already saw the decrease in the strength. We can think maybe they're going to go back to 125, but if they can't go back up to 125, the logical guess would be they would decrease the weight from 100 back down to 75. This is a head and shoulders right here. This is price going from 50 to 75, 100, 125, 100. If we think about it this way, as they started the weights at 50 and then they increased the weight up to 100, then they went up to 125 and then they dropped back down to 100, what will likely happen? And this right here is referred to as the neckline. Are they going to break this baseline of 100? Will they go back up to 125, or will price naturally come back down to where it came from? That is the idea. Again, a lot of these technical patterns can just be applied to what you observe. Think about whenever you're driving your car, think about when you're watching sports, think about when you're in the gym. A lot of these things, you're just mapping the data on a chart, and then we're trying to assign a name for what we're seeing. In this case here, the head and shoulders, hopefully that explains this. On top of that, this information can be compounded, because if price was to go up and then it did this and it tried to go higher and then it did this, guess what this is also referred to? This moment in time right here, this is a 50% retracement, because if price was to start here, so let's just say it started at 100 and then it dropped down to 50 and then it bounced back up to 175, and then it bounced back up to 75. This is the 50% mark between these two. This is the halfway mark. So in other words, if this was a Fibonacci retracement, this is price going boom and then bouncing back up 50%. And then the implication would be that it would continue down. This is a short setup that I've shared a few times on this channel. This is also, this moment in time right here is also referred to as the backside weakness once price fails. This is backside weakness. This is a 50% retracement short. This is the right shoulder of a head and shoulders pattern. All of these concepts start to compound the longer and longer you've been trading. And when you can compound multiple thought processes and multiple ideas, you start building confluences. Then you can start adding other things to your chart to see if you can add even more confluences. But the point behind trading is you're trying to increase as much of an edge as possible for yourself. Here's a channel most recently formed here a couple weeks ago. So if we actually take a look at the chart and let's pull up the SPX. This video is being recorded in November of 2023, by the way, so you guys can go back and take a look at this pattern right here. This was just a channel that was forming, and I was just showing the dates here. This was earlier a couple weeks ago, in which I had shared that in a Discord. And what we see right here is straight out of a textbook. We had a clean channel forming. So this was a Friday into a Monday into a Tuesday. So I shared this here earlier in that week, just letting everybody know, hey, be aware of this channel. And it provided some decent trades. I actually did a video on this on the YouTube channel here about this specific week in time. But what we can see right here, if we actually zoom in, is this is a case here where the expectation would be price broke down from this channel. The expectation would be that it would continue to sell off and then it would potentially fill these gaps on the chart. But as we see, price returns back into the channel. This is a reason now from a risk management standpoint to close out your shorts, because price is not supposed to get back in this channel. This was the break right here. Price should continue selling off. So this is an indication where someone looking at this would say, hey, the channel did not work. Price broke down. It was supposed to sell off and go all the way back down. Why did price go back up? That's irrelevant. The point is, you know where to set your stop loss. If you took the breakdown of this channel and price started selling off, you knew where to set your stop loss. And by closing out your trade here, you're preventing yourself from losing a ton of money, because without understanding that pattern here, let's just say you remained short, you can see how negative that short position would be right now. If we were to take a look at a couple other live examples here, this is back from just 2020. This is on a 1 minute time frame when I used to be more of a scalper. Some of the earlier videos on this channel, you might see some of my technical analysis or how I used to trade back then, especially whenever I was trading the futures. This is a shoulder, this is the head, this is a shoulder. It's just showing some of my entries and exits as I was scalping. But in this case here, I took this short on the break of the neckline. So here, price is going up, it forms the left shoulder, it forms the head, it forms the right shoulder. Here is the neck. I decided to go short. You can also use this as the neck, because sometimes I'm always looking for an earlier entry, especially if I'm scalping. Instead of waiting for price to break down here, I decided to take the trade short up here. But you guys can see this is a neckline, or you can see this is a little bit more advanced. So I guess I'll just skim through this for this video. I just wanted to show you guys a live example, as I still had this floating around on my computer. And then if we just take a look at another example, here is the same deal. Price is going up, it forms a shoulder, it forms a head, and then it forms another shoulder. So this is a head and shoulder. Price goes up, tries to go higher, then it fails, then it tries to go higher. This right here at the break of this zone is where you can look to take your short as price breaks down, or you can wait for the retracement. Price gets back up to the retracement, it fails. Here's your another reason to get short. Right here, stop loss above here. Stop loss can be above the head and shoulder itself, Or in this case here, we can see another reason to take the trade, because now we have a bear pennant forming after price broke down. So this is another opportunity. It's just layering and adding more context to these trades. And the better you can get at reading price action, understanding technical analysis, and then layering that information with risk management and the technical patterns, you will be able to really make sense of what's happening in the stock market from a price action standpoint. Hopefully you guys enjoyed this video. I intend to do a lot more technical analysis and technical pattern videos in the future, as I've neglected those over the past couple of years, mostly talking about a more quantitative approach to trading, but it doesn't mean you have to disregard or throw out everything in which you've learned from a technical analysis standpoint. And even though I realize technical analysis to me is very easy, the more and more traders in which I've been talking to for the past year, I've realized that it's actually not that common for you guys to have a firm understanding of technical analysis. So I'll do my best to share a little bit more examples like this. If you enjoyed this video, let me know in the comments down below. Take care, and I look forward to having you on the next one.